Thank you, Z, and thank you to the Yonkers Public Library for setting this up and for giving me the opportunity to share today some tidbits on how to deal with market turbulence. Like Z said, Aureo Pinto. I am an enrolled agent, tax specialist, registered financial consultant. We do financial planning, all aspects of financial planning, tax planning, insurance planning, retirement, and investments. And with the market the way it is now, it's very important to go through this to help you navigate through the current times, which are very turbulent at this point. So I'm going to be covering understanding market volatility, learning some smart strategies to protect and grow your investments, and recognize common mistakes and how to avoid them. So I like to start with the rule of 72, which is basically a banker's rule. That rule basically uses 72 as the number that you have to use in order to figure out how long an investment is going to take to double, or the interest rate that you need to invest in order to make your investment double. So if you take 72 and you divide it by 3%, you'll see that your investment will double every 24 years. And you could do it the other way around. You can say, I want my investment to double in 6 years. So you take 72 divided by 6, and it'll give you 12. So you'll know that every 12 years, it'll double. So it goes either way. You can either divide it by the number of years or the interest rate, and it gives you an idea of how quickly your money will double and how quickly your money will grow. Obviously, the higher the percentage rate, the quicker it'll double, and the shorter period of time that you want your money to double, the higher the interest rate that your investment has to earn in order for you to get to that point. So I like to always like kind of go through this as pictorial so that you can see the years as opposed to the percentage points in how your money moves. So now, the market turbulence. Over the last couple of months, we've seen a lot of changes in the stock market. Market has gone up, has gone down. It has lost a lot of the profits that it had earned over the last couple of years. So, what is market turbulence? Market turbulence is the unexpected rise and fall of the stock market. And I say rise and fall, people usually look at it as just the downfall, but there could be market turbulence on the upside as well. If you've followed the news recently, especially with regards to the tariffs, when the tariffs have been rolled back or postponed for a certain period of time, the market goes up drastically. So I consider turbulence to be on the upside as well as on the downside, because some of the reactions when it goes up, it's not a true market indicator. It's not a true number, because usually the market gets driven by corporate profits. So if a particular industry is doing well, with the stocks in that particular industry based on their profit and loss, and if they're marketable, they have a good market, they have good profit bottom line. The industry and the market as a whole is going on an uptrend. But when it goes up dramatically, it's not based on corporate performance. It's not based on the expected earnings of a particular company. It's just based on the investors' reaction to the fact that something is going to either happen or not happen, and then they dump more money into the market, and that increases it, which at some time is like an inflated amount, which is not a realistic amount. So I define market turbulence as both going up as well as down. And the common causes are economic downturns. It can be inflation, it can be recession, and I'll go through each of those in a little bit. It could be unemployment, it could be interest rate changes. The economic downturns usually trade wars as well. It includes trade wars, tariffs, import-export balance of trade. The interest rate changes are usually controlled by the Federal Reserve. Federal Reserve will increase or decrease the prime rate which influences the stock market, influences the real estate market, and influences investments as a whole, because it even will impact the bonds based on the interest that they're going to be paying out. And you have global events, wars, pandemic. The two most recent examples are the 2008 financial crisis, which was basically the real estate bubble, the housing market collapse, where mortgages were being issued without banks and financial companies actually doing the full due diligence. Uh, and it turned out to be a subprime mortgage, or the more subprime mortgage market. So they weren't really giving mortgages to the individuals who really had the credit rating and the ability to sustain the mortgage payments. We had global recession during 2008. There were massive job losses. Uh, and the recession, basically, recession is a downturn in economic activity. And that is measured when at least 2 quarters out of every year. So for at least 6 months, there's been a downward trend on the financial strength of the country. And that's measured by the gross domestic product, which includes trades as well. And then the opposite of that would be inflation, where the prices increase over time. So your money is buying less, but your income is not necessarily going up at the same rate. So, and that's measured by the consumer price index, the CPI, and that creates inflation because there's not enough money in the economy to actually purchase these goods at the higher price. So we went through that in 2008. We had mostly a recession, and then we hit a little bit of an inflation toward the end. And then we had the COVID-19, which created a crash in 2020. In March of 2020, the stock market went down over a period of 4 days. It went down over 6,000 points, which at that point was about 25% of the market share. And that was due to shutdowns of business. Businesses just had to shut down. There was quarantines. There was no economic activity for the most part. Some industries stayed open, but with quarantines, it was all virtual, which impacted productivity and things like that. So those are the two most recent examples of market turbulence. Now, currently, we have market turbulence due to the trade wars, tariffs, and things like that, which I'll cover in a little bit toward the middle or toward the end of the presentation. And market turbulence then leads to emotional investing. So, emotional investing is, like I said earlier, some companies, based on their profit margin and their profitability, the companies in that particular industry make that index go up based on facts of the company's sales, profit, their employment, their market share. So emotional investing basically has you investing not based on those metrics that you know are hard numbers that you can rely on, but basically on a feeling. You feel that the market's not doing well. You feel that, or and fear that you're going to lose money, so you wind up selling. And when you invest based on emotions, usually you underperform in your market. And that's because you wind up, for the majority of the time, buying when the market is high and selling when it's low, when in fact it should be the other way around. But there's really no way of timing the market. So it is all goes back to your goals and the purpose that you got into the market in the first place. So avoid, and it's very difficult, but one of the problems is the fear and the greed will cloud your judgment because you're trying to time the market. Panic selling, where you're afraid of losing more, so you decide to sell. Uh, FOMO, which is fear of missing out. So you hear like a good tip, somebody says, "Oh, I invested in this company and it looks like they're doing really well." You jump on the bandwagon and you might have picked up that stock already at the high point and it has nowhere else to go because if there's no market share or if there's no increase in the market share or profitability or sales, that stock is not going to continue staying at that level. It's going to start coming down. So you've at that point bought at the high point, and you're going to wind up selling at the low point. So it's very important to stay calm. Don't check the market on a daily basis. You can check it weekly, maybe monthly. Sit with your financial advisor, your accountant, and tell them I have this particular investment. What's going on? What should I do? Get some advice as to what to do. And very likely, that financial planner or that accountant should be telling you to just stay still, don't do anything, don't sell because you're going to take a loss. Just wait it out. Wait to see what the market is doing as a whole because the market will recover. Stick to your goals. If you invested in a particular investment, or if the majority of your investment is in a retirement plan, and you still have time to make up that time in your horizon. You still have 5, 10, 15 years before retirement, at least those years. Stick to your plan. Keep the money where it is. Don't move things around. Stick to your goals. Whatever your goal was initially, your plan, that shouldn't change based on the market performance. You can kind of move around if you're in a diversified mutual fund and you get something that's kind of similar to where you are, but might be a little bit stronger. But other than that, I strongly suggest not to sell and not to move any major chunks of money around when the market is in the downturn. Um, if you do that, you've locked in your losses. So let's say you have $10,000 that you invested, and over the last couple of months now it's down to 7,000. If you sell that 7,000, you've clocked in a $3,000 loss that is now a realized loss. Now you need to find somewhere to invest that 7,000 so that you can bring it back up to 10 and more. So you lost 30%, but now you have to invest in something that will give you 50, 60% in order to get back to where you were and then some. The market in a short period of time does not turn over that quickly. So you're better off staying in that particular investment. If that investment was good when you first went into it, it should still be good. Keep it where it is, and as the market continues to recover, that 7,000 will become 7,200, 75, 8,000. It'll continue going up. And it'll probably recover much quicker than if you are starting now with 7,000 in a different investment altogether. So always keep that in mind. Don't jump around, stay where you are. You can't time the market. So wherever you are, just it's one of those waiting patterns. You wait and see what's going on. If at some point it looks like your company is going into financial trouble because of its own industry, it's going bankrupt, or sales are really down, or it's going to be merged with another company, and the returns on it don't look like it's going to be really be worth it, then at that point you can sell that particular investment. But just because of what the way the market as a whole is moving, I would not move around. Okay, so this screen might not be too clear, so I'm going to kind of walk through it. So there are, since from 1937 to 2024, it was about an 88-year period or so. So during those 88-year period, there was 21 years where the market was down, and there were 67 years where the market was up. The average down market was 12.5%. The average up market was 19.9%. And then these columns kind of break it out into the percentages. So for the downturn, first column on the left, there were 3 years that were the lowest. First one was like 37%, then 26%, and then 34%. And those were in 2008, 1974, and 1937, respectively. So you'll see that it's usually like a trend. And on average, between 6 and 8 years, the market does a full cycle. It goes through recession, it goes through inflation, it goes through an upturn, it goes through a downturn. but it continues to overall go up on an uptrend. If you look at the right side, 67 years were positive years. And out of those positive years, if you look at the far right column, 23 years were at least 24% increases. So the uptrend over 88 years was higher than the downtrend. So over 88 years, 21 years were down. That's 24% of that time period was downturn. 67 years were high, and that's 76%. So on average, you can safely say that over an 80-year period or so, at least 70% of the time, the market will be high as opposed to a low. And over that overall 88-year period, the market went up 10.7% average annual return. And that's smoothing out the downturns and the upturns. So on average, the market has gone up 10%. So that's something to always remember that you're losing like over the last couple of months, depending on what you were invested on, you could have easily lost 20, 25, even 30%. Um, but don't fret, the market will come back. Uh, Things will change. This is just caused due to consumer sentiment. Like I said earlier, it's a panic selling, panic buying, and just the term of tariffs. So I'm going to go through tariff really quick, a little bit of a primer here. A tariff is not a tax, as it's been said in the news. A tariff is it's similar to like an excise tax, but it's not an income tax. So it's not something that the government profits from. Tariff is placed on an importer on the products that they're importing from a particular country. So if I am importing something from, let's say, Asia, I have a company, I have a retail business or even a wholesale business. I buy a container full of merchandise worth, let's say, $100,000, and it's coming from China, and China is now getting hit, hypothetically, 50% tariff. I, as the owner of the company that's importing these products, have to pay 50% to US Customs before they can release that container to me so I can sell my products. I have to pay 50% tariff on the value of the merchandise that I'm bringing in. And it's based on, it's a combination of what it's costing me, and there's a particular percentage that gets applied. So it's not at full retail. So it's a little bit over my cost. So if that container cost me $100,000 worth of merchandise, I have to pay 50% tariff on that value. So now I pay the $50,000, 50%. Now that container of merchandise has cost me 150,000. I Customs releases it. I take the merchandise to my warehouse. I put it on the shelves. I start selling it. If I initially had to sell each of those widgets for, let's say, $12 in order to make a profit, now I have to sell them for $18 or $17 in order to make a profit because I need to now recover the $50,000 in tariff that I paid. So the consumer is the ultimate payer of the tariff because me as an importer and a wholesaler, I'm paying it, but I'm not going to take the hit on that out of my pocket. It's not going to come out of my profit. I need to build it into the price that I'm selling it at. So the ultimate consumer who buys that product is the one that's paying the tariff. Uh, that's how tariffs work. The government itself doesn't really make money out of it. Like the $50,000 that I paid customs, yes, that goes into the government coffers, but that doesn't really raise money for the government because I didn't pay for it. The consumer's paying for it. So technically, the consumers are the ones that are now supporting that particular tax that's going to the government. Um, so these trade wars and these tariff wars have caused people to feel uneasy about certain industries. So if you know that you need to buy a car in the next 6 months and there's a tariff going on, you now have to buy a car now before the tariff hit. Otherwise, you're going to wind up paying more for the car later on. So that has led to people not to invest as much in the stock market as before because now they need cash to be able to pay and to purchase what they planned to purchase, which might now be much higher than they expected it to be. And I use car as an example. That's the high ticket item that's going to be impacted by tariffs, but everything's going to be impacted by tariffs. Anything that comes into the country that we import. And same token, whatever we export, the country that's buying it from us, those consumers are paying for it. So when tariffs go up, people kind of panic. They're like, oh, I can't invest in the market. I got to pull my money out. I got to save it for a rainy day because this is going to happen. Eventually, I'm going to be spending more. Um, that turns the market down. So the market, that's when it hits that downtrend. When tariffs, you'll hear the news that tariffs have been either reduced or they're going to be postponed for 60 days, 90 days, whatever it is. The market goes up because people say, oh, now I don't really need that money right now. I can dump it back into the market and see if I can make some money in the stock market. So that's what's been making the market fluctuate. Normally, the market does not fluctuate that quickly or that drastically over news, but this has caused it. And this is a chart that I have shown before, and it's similar to what I did before, showing the up years and the down years. This covers 10-year period from January of 2010 through December of 2019. And it'll show the investments and their particular returns. So the S&P 500 during that time period returned 13.5%. So if you were in any of those stocks within the stock market, within the S&P, that was more or less your average return during those 10 years. And you'll see that it's also color coded. So aggressive growth, which would be basically anything over 90% of the investment being in stock, uh, increased from $1,000 to 3,500 at the end of those 10 years. And then it's growth, moderate growth, conservative, and income. So even on the income side, which would basically be your short-term interest rates, your regular savings account, which were like 3% or so. Over 10 years, it went from 1,000 to 1,900. So it almost doubled. Um, so this also shows that over time, the investments continue to grow, even though you have these blips. If you look at between 2017 and 2018, there were a couple of peaks and then a couple of valleys where it came down. Toward the end of 2018 and 19, that's where you see that big downturn. But overall, if you're in the market, you're able to stay to keep the risk, to deal with the risk, and your goals have not changed for the purpose of that money, I strongly suggest stay in the market. So the do's of investing. Number one, stick to your long-term plan. Like I said earlier, your goals, your plans, what was the purpose for that particular investment? Is it retirement? Is it purchasing a house? Is it getting a car? Usually car is like short term, but using that as an example at this point. So stick to your initial plan. Number two, keep investing regularly. I always recommend dollar cost averaging, which means that you put a fixed amount on a regular basis into a particular investment. So you can do $50 a month, $100 a month, and you put it into either a particular stock or a mutual fund. I always recommend mutual funds because you can diversify and you can have a good mixture within a mutual fund where it's not all stocks, not all bonds. So if the market goes up or down, it's kind of cushioned in a way. There's a buffer because you have some stocks that if they go down, the bonds will still protect you. If the interest rate goes down and the bonds kind of like dip, the market usually goes up. So on the stock side, you should be okay. Um, so if you invest into a mutual fund and you do dollar cost averaging, so you do $100 a month, when the market is high, that $100 will buy you fewer shares in that mutual fund. When the market is low, that $100 will buy you more shares because now you can buy more. But at the end of the year, And there has been empirical studies that show that over a particular period of time, dollar cost averaging, you wind up making more profit overall because you're not timing the market. You're doing it on a regular basis. So you're reducing that market risk of timing it and buying more or putting more money when it's low than when it's high. And it also disciplined investing. So it's one of those like set it and forget it. So you can do it automatically, $100 out of your account every month, go into the investment. Overall, you'll be picking up stocks less when it's high and more stock shares when it's lower. And that's always worked out great. Instead of dumping money sporadically, different amounts, which you can also, but it's highly recommended. And dollar cost averaging is much better. And diversify your portfolio. Like I said earlier, you have, a good diversified portfolio will have a good mixture of stocks, and it will have value stocks. It'll have investment stocks that pay high dividends, so you get the good income piece of it. It'll have bonds. It'll have other fixed assets. So a diversified portfolio, you can do it through one mutual fund or a few mutual funds. So you don't have all your eggs in one basket. You don't get hit with the market when it goes down. The loss is fairly cushioned because you have protection from other types of investments within your portfolio. And the do's in investing, just like I said earlier, with goals, continue your goals and stick to your goals. Always have an emergency fund. Make sure that you establish it and maintain it. And that should include 3 to 6 months of your living expenses that you need in case of an emergency. You get sick, you lose your job, or whatever else happened and your income is reduced. At least you have that savings that'll cover you for 3 to 6 years until 3 to 6 months until you're able to recover. Rebalancing your portfolio. If you have a diversified portfolio, sometimes you might not need to rebalance. But if you're very heavy into stocks as opposed to bonds, and you're feeling a little bit uncomfortable about having so much in the stock market, and you're afraid of losing much more than you're comfortable with as far as taking the risk, then you should rebalance your portfolio to make sure that you have enough diversification between stocks and bonds. And consult trusted financial advisor. It can be a financial planner, an accountant who knows investments, who knows the tax impact of investments. Always consult with them and get their opinion as to where you should be going, whether you're in the right place, and if there's any changes that they see that you should probably consider. Moving to the don'ts. Don't panic sell. That's why I said stay away from tracking the market very often. If you hear that the market is crashing, it's down 600 points, don't panic sell. Don't say that you need to get out of it because you're afraid of losing more. Stick with it, stay in it. Don't try to time the market. We can never time the market. There were back in the 50s and 60s and even 70s, there was an easier way of tracking the market and timing it because financial analysts would actually visit companies. They would talk to the board of directors, they would talk to the CEOs and the CFOs, and they would look at the financial statements, the balance sheet, the profit and losses. They would look at the market share, and they would know whether this company was profitable, whether this company had a good business plan, whether they knew what they were doing, whether management was strong enough to make the company succeed. And they would go out and they would recommend a particular company to all their clients. They would say, yes, go out and let's buy Ford stock or let's buy IBM stock. But that was based on their own research and their own analysis. During the 90s, late 80s, 90s, when people started looking more into doing their own research and the internet became more popular, people would start doing their own market research and look at companies and say, okay, I think this company is good and I'll invest in it. Sometimes that would work if you knew what you were looking for and what the correct metrics to look for were. but it's very difficult to do that. So don't try to time the market. Don't go based on hints or on tips. Just really look at where you're invested and if you're comfortable with that company, if you're dealing with a particular stock, and if you're willing to take the risk. Some people will not buy stocks that are against, the environment or for whatever other reason. So, if you're not interested in those, you don't invest in those. Um, if this particular company that you like, you use their products. Back in the 80s and 90s, there was Peter Lynch, who was with I think it was with Fidelity that he started off with, and he wrote all these books about how to buy stocks and why to buy and all that. And what he would do is he would go to the shopping malls with his kids and he would see where the majority of the kids were buying, which stores did they go into and why. And then he would research those businesses and those companies if they were publicly held. And he would invest in those in the mutual funds that he was setting up and in his client base. And that's how he would do it. So if you're comfortable with a company, if you like Ford cars and that's the only car that you've ever owned or GM car, and you like to buy their stocks, buy their stocks. They're actually pretty good at this point. Their dividends are pretty good. So go based also on your likes if you're buying a particular stock. If you're buying into mutual funds, also look at their environmental and their ethical behavior. Do they invest in companies that are cigarettes, cigarette bound or tobacco industry or things like that that you might not agree with, or energy industries of some type. So just look at that as well and be comfortable in your investment and stick to it. And don't try to jump from one investment or one industry to another because it overall you'll wind up losing more than any gain. And again, this last one, don't chase hot tips or trending stocks. By the time with the internet the way it is, by the time you get a hot tip or you see a stock that's trending upward, that upward trend has already taken into account all of the industry hype through the internet. So by the time you get in, you're probably buying it at the high point, and there's very little left for it to go high. It'll flatten out, it'll plateau, and then eventually come down. So avoid those hot tips. A few other don'ts of investing. Don't ignore your risk tolerance. So, how much risk are you willing to take? Are you willing to buy into an industry, into a stock, into a mutual fund for the long period, regardless of whether it's up or down? How much loss are you willing to take? Some people, even though I suggest stay in the market for as long as you can because you will make your money eventually, some people just can't take it. They're so afraid of losing money. So early on, when you first start your investment portfolio and you embark on this, look at how much risk you're willing to take. Are you willing to take a 10%, 15%, 20% downturn if it goes that way? Are you willing to take the risk of investing in certain companies that might not be liked by everybody? That's a risk that you need to define upfront and then stick with it and continue going through it. Don't put all your money into one particular asset. That's why I talked about diversification. Don't put all your eggs in one basket. You should be putting money into a diversified mutual fund that has stocks, it has bonds. It has different kinds of stocks from large cap companies, small cap, maybe some international. It should have treasury bonds. It should have high quality corporate bonds. So that'll be a good diversified portfolio. One, two, maybe three mutual funds that will encompass basically a little bit of each of the market industries, and that'll give you a good bucket to invest in. And don't stop learning. Read as much as you can on investments, on what the market is going through, but research to understand why the market is behaving the way it is. And that'll get you to understand that sometimes the market reacts with no real financial reason for that particular industry. It's just based on a trend, on the news, or on something that the government is doing or is failing to do that's going to impact a particular industry. So research everything, don't stop learning. And tools and resources for the learning piece, apps. Um, I have Mint here, but Mint recently rolled into Credit Karma. So, and it has Credit Karma has basically the same thing that Mint does. It has a little bit of a budgeting aspect to it, very small budgeting module in it. But Mint, which is now Credit Karma, basically what it does is an investment consolidator. So you would link all of your investment accounts through the Credit Karma app, and it'll show all of your accounts listed in one page, so you don't have to log into Schwab or Fidelity or any of the other market uh, brokerage houses. It'll be all in one app. It'll show you the trend of your total amount, total gains, total losses. I believe now you can also add your regular savings and checkings and everything else, even credit cards. So you have everything in one particular app. And that's something good because it gives you in one location, it tells you everything. You have your whole financial history, your whole financial position at that point. Personal capital is the same. There's different apps that help you with budgeting, help you with consolidating all of your accounts, help you analyze whether you're in the right place or not as far as your investment and your age and your risk tolerance. And then there's some that actually track your for budgeting purposes. It'll track your expenses and it'll see if you have any redundant subscriptions or if there's any subscriptions that for some reason it will ask you, do you still read this? Do you still read the People magazine that you're subscribing to? Do you still read this particular newspaper? And it'll help you eliminate a lot of subscriptions on stuff that sometimes they're automatically charged to your account and you don't notice after a couple of months and it continues to go. So this will keep track of all the recurring um, charges to your account and it'll kind of highlight and say, is this still a good charge? Are you still doing this? Do you still need this? News, CNBC, Bloomberg, Morningstar, they're all great. CNBC and Bloomberg actually track the market. They have, I want to say, unbiased uh, market analysis. Sometimes you will have somebody put in a plug for a particular stock. Just take those with a grain of salt. Do your own research as well. Morningstar is basically a review service of mutual funds, stocks, and bonds, and that one's always good. It'll give you a rating, whether it's a buy rating, a sell rating. It'll tell you the good, the bad, and the ugly of basically any investment that it tracks, and that's a good one always. And reputable podcasts and blogs. um, many years ago, there was a particular group of investors, and they opened up a website called The Motley Fool. And from that point on, they have blogs, they have they're on YouTube, they have their own podcast, they have their own website through subscription where you can get a little bit more personalized service and more information. And they've also written several books. There's one that they wrote for teens, which is the Motley Fool Investment Guide for Teens. 8 steps to having more money than your parents ever dreamed of. So they have very good books out there, and it's also unbiased. They just go straight into, they dissect the market and they explain it in a way that's very simple. So that would be like a reputable site that you can go through in other podcasts as well. Okay, case number one, Tina sells in a panic. What happens? Any responses through the chat? Let's see the chat on my side. The, I guess after that means we should just write out the waves. Oh, I missed this one. Okay. Yes, write the waves for now based on your risk tolerance. If you don't panic and you still want to stay where you are, I strongly suggest that you stay. Write it out. It will recover. Uh, and it will recover to your benefit much quicker than if you jump off and you go into a different investment. Let's see. She loses money in the long run. Yes, that's true. If you take your money out of a particular investment because you fear that the market will continue to go down, you will ultimately lose more than if you were to stay in it because your investment, if it was good when you first went in it and you were comfortable with it, it will help you ride out those ups and downs. And then once it recovers and it's high, if you don't want to go through that experience again, then I would take it out because at that point you're not losing money, you're actually profitable, and then move it into something that's a little bit more conservative if you do not want to go through the waves again. Uh, Usually between 6 and 10 years, there's always market upturns and downturns. You'll have, like I said, there's a whole cycle, inflation, recession, unemployment, and then it kicks in again. So if you don't want to go through this experience again, once it recovers, then go into something that's a little bit more conservative. Those are good questions. So let's go back to case one. Tina sells in a panic. What happens? So Tina will, like CZ, he said, she loses at this point because she'll sell at a loss. Now she has less money to invest in a market that's already on a downturn. It's already turbulent. Uh, and she'll have to now wait for a longer period of time or get into an investment that's riskier than what she was in order to make back what she lost and then some to make it profitable. So that's one of the reasons you never sell in a panic because you wind up losing a lot more overall. Case number two, Jay invests in a downturn. What happens?
Hi, Oreo, it's Liz.
Hi, Liz.
I'm gonna jump in on this one.
Mhm.
I think when you invest in a downturn, I think for me, I think it's good because, like, let's say there's like a recession or like the stock market prices drop. Like, I would think that is better for you, better opportunity for you to invest. If I'm saying this correctly. Um, so, um,
Mhm. Yeah, yes, I agree. If you're investing in the downturn, you're willing to take the risk that it might continue going down, but you're also looking at the positive that you might be picking it up at the best price that it's available now. And if you're investing in a particular company, you know that that company is a good company, it's a strong company, it's been profitable for a very long period of time, then you know that that downturn is a temporary downturn and not something that that particular company is going to be suffering for a long period of time. It's something that the whole industry or the market as a whole is going down, and that will recover. So that if that's how you're looking at the investment, then yes, it's a good time to invest in a downturn. If and you're willing to take the risk of it might continue going down for a little bit longer. Again, not timing the market, but if it's low and you're like, you know what, I really think that this company is going to do well, it's just going down because everything's crazy at this point. I'm going to invest in it, then you're in a good spot. If you're doing it with a mutual fund, it's probably even better because the mutual fund is already diversified and it's very likely that the portfolio managers are buying more of whatever free cash they have into the industry, into a particular industry that they see is probably taking a beating, and it shouldn't be. So you'll very likely recover much quicker and you'll turn profitable fairly quick when the market turns back up. So yes, that is a good point.
I agree that it is definitely mixed feelings because, like you said, it can continue dropping, or as it drops, you have that opportunity to invest more.
Right.
Um, but I mean, I don't invest in the stock market, so
Mhm.
you know,
No,
um,
but that is a good
it's a little scary to take
good point.
risks, but sometimes they're worth it. So
Right, right. And one thing that you have to look at is like, okay, so it's going down and it's in a downturn and you decide to put in, even if it goes down a little bit more, you've lost much less than somebody who was already in the market from day one when it was very profitable. So it's not like it makes you feel better because you're losing less than somebody else, but you have to think that, okay, I'm picking it up at a lower loss And when it recovers, I'll recover much quicker. And then as it continues, everybody else who's been in it and is still in it will then recover their losses and they'll be back to where they were. They'll be whole again. Um, and again, not timing it because you can't time it. But if there is a good opportunity and the company is good, if you're going for individual stocks, then yes, it's a good thing to do. Okay. And now a little pop quiz. True or false? You should stop investing when the markets drop. Okay, yeah. So somebody put false. That's right. Yep, it's false because stay in it for as long as you can. Um, it'll come back, it'll recover. Might not be in the next 6 months or in the next year, but the cyclical nature of the stock market does recover. Like I said on average, 10%, 10.7%. It was a 10.7% increase over the last 88 years. Uh, yeah, 10.7%. So the market does recover. So that's a false. Stop investing when the market drops? No. Continue investing. And if you're in the dollar cost averaging, as the market is dropping, that $100 that I said initially that you're probably putting in a month, you're buying more stocks or more shares in the mutual fund as the market drops. Now, when the market starts recovering, now you have that many more shares that are going to increase in value much quicker and exponentially because now you have a bigger investment at a lower price. And the second bubble on the right, let's see, what is not a good strategy during turbulence? What should you not do during a market turbulence? So remember, market turbulence is when it goes up or down. Um, this case, I'm going to say, let's say it's a dip. So if the market turbulence, the market's going down, what should you not do? Panic sell. Do not sell based on panic. So if the market's going down, don't sell based on panic. Go through your goals, go through your investments, see what the risk is, see how far it's going down. Are you comfortable in staying with it? Yes, and somebody put it in. Yep, exactly. Don't panic and don't sell. Now I think we're down to one or two more slides. So final tips and encouragement, stay informed. Don't get overwhelmed. Stay away from those tips, those hints, the stock tips. This company is good. Buy now before everything else happens. Um, do your own research on Bloomberg, CNBC. Look at the different websites. Look at the Motley tool. Look at Morningstar. Look at and even if you don't invest in a particular company, you can go through like into the Schwab website and Fidelity website and research. They have market analysts putting general research information as to the market, the way they see the market. And you're getting it from a fiduciary who's licensed and who knows what they're talking about. That's probably the best information to get. So always stay informed. Be proactive, not reactive. Look at the market in a positive way and see how you can maximize what you're doing, even if it's in a downturn and it's in a loss situation. Don't panic sell. Don't react to like the market has over the last couple of weeks with the tariffs up or down based on where we are with tariffs. Don't be reactive. Be proactive. Wait and see. Sit it out and see what happens. Uh, the markets rebound over time on a cyclical basis, usually a 10-year rolling period. The market will does improve, does come back, and there's always a cycle. So regardless of how bad the downturn is, over the last couple of months, this downturn has been probably one of the worst. Uh, but over the last 20, 30, 40 years, every 6 to 8 years, we've had an inflation period. We had a recession period. Uh, Back in the 70s and 80s, we had the gas lines where it was like crazy. You had to wait in line to get gas. So we've seen this before. It just hasn't been as dramatic, as drastic, uh, but we've seen it and it always comes back. It always rebounds.